In 2026, getting access to capital is still one of the biggest challenges facing the 33 plus million small businesses that power America. But the data reveals exactly why some owners get funded while others keep getting rejected. Now, I'm not a CPA, so be sure to check with one for any kind of tax or financial advice. But today, we're breaking down the latest small business lending statistics, approval rates by lender type, default numbers, SBA trends, and most importantly, what you can do to dramatically boost your odds of getting funded. These insights could save you months of frustration and thousands of interest. So let's dive into the numbers. There are over 33 plus million small businesses in the United States, and they employ nearly half of the private workforce, yet only about 1/3 actively seek any kind of external financing in any given year. So why is that? Well, many fear rejection or they don't exactly know where to go. The total small business lending runs into the hundreds of billions annually, with the SBA alone guaranteeing tens of billions. But here's the reality. Fewer than half of the applicants actually get the full amount that they request. Understanding the data is your first step to beating those odds. In 2026, with interest rates still a top concern and fintech options expanding, the smart owners are matching their profile to the right lender instead of just applying everywhere. So this is where most business owners get it wrong. Approval rates can vary wildly depending on who you ask. Large banks like a Chase or Bank of America, they're in the 13 to 15% approval. They want a 700 plus credit, 2 years in business, collateral, and strong revenue. They often have the lowest rates, but they're often the toughest to get. Then you've got community and small banks in the 19 to 22% approval range, more relationship driven and more flexible, often better for local businesses. Credit unions in the 20 to 24% approval range. They are member friendly with competitive terms, though loan sizes can often be smaller. You've got online and alternative lenders at 26 to 30%. You get faster decisions. They're more flexible on credit and time of business. They have higher rates, but quicker cash. You've got SBA loans, effective approval around 40 to 60% for prepared applicants. The government guarantee helps, but the process often takes longer. Lenders price risk based on defaults. Here's the data. Traditional bank loans, they are in the 2 to 4% default rate in normal times. SBA 7A loans, 1.5 to 3.5% charge-off rate. Online alternatives in the 5 to 15%. Merchant cash advances can exceed 15 to 20%. Your personal credit score is still a huge predictor. Scores over 700 see defaults under 2%, while under 600 can hit 15 to 20%. This is why cleaning up your finances, separating personal business spending can pay off big. Revenue-based financing and lines of credit can lower effective default risk because payments flex with your sales. The SBA guaranteed over 55 to 56 billion in fiscal year 2024, with key programs include the 7A loans, averaging around 542,000, great for working capital, equipment, etc. 504 loans for real estate and big equipment over $1 million, micro loans, smaller amounts for startups and underserved businesses. So the trends for 2026, faster digital applications, fee relief on smaller loans, and expanded programs for underserved markets. Top industries include restaurants, professional services, retail, healthcare, and construction. So don't just hope that you get approval for a loan. You have to really prepare. So you have to know your numbers. You have to have strong cash flow, revenue trends, DSCR above 1.5 to 2, build the business credit, separate finances. You have to match your lender with your profile. If you're a newer business, try online. Strong credit and collateral, go for a bank or SBA loan. Prepare your documents, tax returns, bank statements, business plans, financial projections. Consider the timing. Apply after strong months. Shop multiple options through a broker or network. Explore alternatives, lines of credit, equipment financing, invoice financing for a better fit. Remember the trade-off. Lower approval chance at banks usually means cheaper capital. Online equals faster and easier, but they come at a higher cost. Always calculate the total cost of capital, not just the rate. The statistics show it's tougher than ever at traditional banks, but opportunities are everywhere if you know the landscape. The businesses that win are the ones that prepare, match the right lender, and act strategically. Drop it in the comments. Have you applied for funding recently? What was your experience? Did you get approved, denied, or are you still waiting? You've built a business, now get the capital that it deserves. If your QuickBooks account needs a bit of cleaning up before you actually apply for that loan, I am a certified Intuit QuickBooks ProAdvisor, and I can help. Thanks for watching, and I'll see you in the next video.